Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, probably the most popular video each month, the stocks I'm buying. But more importantly, this week, the stocks and sectors I'm watching as we head into 2025. We're starting our list of best stocks for the year within different themes, and I wanted to check in on the biggest analyst recommendations and which ones I'm starting off buying right now, along with some important updates to shares of Netflix and MicroStrategy. But first, again, we're just getting started on our best stocks of 2025 lists, and I want to take you along with us. The next 2 months, I'll be highlighting the best stocks to buy in everything from dividends to growth, the headline stocks that could surprise, and the news that could drive the stock market. And because I feel we need more accountability here on YouTube, this year I'm tracking those stock picks. Look for the link in the description below for access to our best stocks tracker. I'll add stocks to the list and track returns against the S&P 500. You're going to get free access to that updated list anytime you want, and a heads up before the videos come out, so check out that link below. For my New Year's stocks, I thought I'd first look to Wall Street consensus to see what the analysts are watching, including the sectors to watch for 2025. FactSet Research is always a great source for analyst targets and regularly posts a list of most and least recommended stocks. Overall, we see that of the 12,000 analyst ratings on stocks in the S&P 500, just over half, about 54% of them are buy recommendations, while 40% are to hold, and just 6% are to sell the stock. Now, this is pretty much average for those perpetually optimistic Wall Street analysts because their banks want those investment banking dollars from the companies, and there's no faster way to lose that than to have an analyst at your firm trash a stock with a sell recommendation. But we can still use these in a relative sense to compare those sectors, see where the analysts expect the most upside. The 3 sectors have more than 60% of their ratings a buy recommendation: communication services, technology, and energy, with just 3 to 5% of those ratings in those sectors to sell. Now, on the flip side, analysts are not loving the consumer staples or utilities sector, with just 41% and 48% of the stocks in those sectors rated to buy. We can always see what stocks we're talking about and get other ideas from the sectorspiders.com sector tracker. The communication services sector is up 36% this year and includes old and new media like Netflix, Meta Platforms, and Fox, along with internet names like Alphabet. Energy is an interesting one here, up less than 1% this year, so it appears analysts see some deep value in that space. Here you've got favorites on the channel like Diamondback Energy, Chevron, and Devon Energy. Those recommendations to buy communication services and technology stocks is really just a play that the bull market is going to keep running higher. On 25% plus runs in the stocks and valuations where they are, you can't say recommendations are on a valuation basis here. These stocks are expensive, but still have that momentum behind them. On the other side here, I'd have to agree with that more negative sentiment on utilities and consumer staples. Stocks in the utilities sector have jumped 20% this year on the hope for that data center demand, but most of the stocks in the group are overvalued at this point. Consumer staples have struggled against inflation and higher rates, and it doesn't look like that's going to change into the new year. While I continue to see that market weakness and even a 10% correction into the first 3 months of the year, something I pointed out in our 2025 Outlook video posted Friday, I do like those communication services and the technology sectors. When we do finally get that pullback, which may have already started, the valuations in this growth and tech stocks are going to start looking a lot more attractive, though I would hold some cash back and some money in bonds until that opportunity comes. Looking closer here, we see 9 stocks in the S&P 500 with more than 90% buy recommendations by analysts. Shares of Axon are still riding high after its addition to the NASDAQ 100 index this month, but looks a little stretched at this point. And here, I'm not nearly brave enough to step into Delta Airlines and the basket case business model that is air travel right now. And I'm also not sure what analysts see in Trimble, ticker TRMB, either. The company did have a strong third quarter and is a good competitor in that software space, but shares are relatively expensive here, and revenue is expected lower by about 5% this year and next. With 93% of the analyst ratings on the stock a buy, I think the sentiment is overdone on that one. We do have 3 of the Magnificent 7 tech stocks still making the top 10 list. Microsoft, ticker MSFT, and Amazon, AMZN, both with 95% of their ratings a buy, and Nvidia, ticker NVDA, with 92% of its ratings a buy recommendation. Of the 3, I'm buying shares of Amazon, which this month unveiled a breakthrough in its own AI semiconductor chip. These Trainium chips aren't really a competitor to Nvidia's GPU dominance, but are a strong alternative against the cost and supply constraint on Nvidia's chips. Used in AWS cloud services, we've already seen news that Apple is using the chips for search and possibly AI training. Shares of Walmart, ticker WMT, have boomed 74% this year, with analysts still bullish, but I'd prefer Target, ticker TGT, at this point. Now, besides the obvious valuation difference here, with Walmart trading very expensive at 38 times on a PE basis versus Target at just 14 times price to earnings, there's also another theme I'm watching in this space. We're already starting to see considerable weakness in consumer spending at the lower end of the consumer market. Now, Target customers aren't exactly eating caviar with their Grey Poupon, but it is a slightly higher economic group than the Walmart demographic, and this is coming from someone that shops at Walmart, so I wouldn't be surprised if Walmart revenues disappoint a little, while maybe Target does better than expected over the next year. Here we see 10 stocks with the highest sell ratings among analysts, including 6 with more than 1 in 3 analysts saying dump the stocks. Garmin, Franklin Resources, Expeditors of Washington, T. Rowe Price, FactSet, and Paramount. Now, these are sometimes a good place to look for those stocks where analyst sentiment has just gotten so negative that any positive news can snap the shares higher. But it is difficult to get excited about any of these names right now, though Palantir has been one of my best stocks in the portfolio this year. I'm not buying any more shares of PLTR right now on these sky-high valuations, but would consider it again if we see a pullback. Besides Amazon and Target, I'm also buying 3 other stocks this month. First, adding to my position in shares of Ally Financial, ticker ALLY, and its 3.4% dividend. We've made a 60% return on shares of our favorite fintech, SoFi Technologies, ticker SOFI, this year, and I'm up 167% in my portfolio. But shares are tragically expensive at this point, trading for a price-to-book value of 2.8 times, which is about twice the book value multiple I'm comfortable buying these shares. Now, Ally doesn't have the same growth, only expecting to see revenue 8% higher next year versus 17% growth for SoFi. But the valuation is so much more attractive at just 0.9 times book value. Here, even a rebound back to say 1.05 times book would be a 17% return on top of that dividend. Ally is a solid fintech, and while auto lending is still its bread and butter, it's also the largest digital bank with growing business in insurance, credit cards, and home loans. We saw some weakness in auto loan charge-offs in the previous quarter, but household finances are still really good, and modest economic growth is going to keep these from getting serious for the bank. I'm also adding to my position in bonds with the iShares U.S. Aggregate Bond ETF, ticker AGG, to protect my portfolio over the first quarter. The jump in interest rates over the last few weeks has pushed bond prices to near their lowest point of the year, and we're very close to that point where higher rates start weighing on the economy and investor sentiment. If rates do stay high, it could force that market correction and add to fears of a slowdown. That in turn would lead the Fed to lower its benchmark rate faster to support the economy and bring other rates down. Lower rates means higher bond prices, so not only would the AGG return to, say, maybe $101 per share for about a 5% return on top of that dividend, it would also protect me from that stock market sell-off. I'll also be adding to my position in Supermicrocomputer, ticker SMCI, over the month. Shares are up 15% from my cost basis on 15,000 shares, but as I pointed out in our December 9th update, we're seeing that disappointment as investors just get impatient for the company to file its latest reports and stay compliant with its NASDAQ listing rules. Now, I pointed out then that while the independent investigation found no accounting problems and the company has found an auditor, it's still going to take time until probably well into January and likely into February to prepare and file those reports. An impatient market is now selling out of the stock, and I'm again buying on those price targets I shared with $40 each on the low side and well over $100 a share on the high side. Looking at the stocks I'm watching this week, first up, Netflix, ticker NFLX, is up 35% since recommending it on September 9th on the build-up to that Season 2 of Squid Games. I did binge watch the series Thursday night and then took some profits selling shares of Netflix on the next day. The company is still the dominant player in streaming and is expanding into sports, but those initial reactions to Squid Games, a breakout sensation that really launched Netflix K-drama success, have not been good. In fact, shares of Korean companies related to the production plunged Friday, with Artists United down 30% and Dexter Studios down 24% on the day. Now, besides just the hit to sentiment for the streaming company's ability to create a global sensation, the disappointing sequel isn't going to keep anyone from ditching their subscription into the first quarter. Now, I like the shares long-term for its streaming dominance, and my wife can't live without her K-dramas, but it's a good time to take some profits in an expensive stock, trading at 10.8 times on a price to sales, versus that 8.5 times average multiple over the last 3 years. Now, I would be back as a buyer at around $750 a share, which would be right around a 9 times multiple on revenue and a much more attractive valuation. Next, folks, MicroStrategy Inc., ticker MSTR, has a math problem. Now, if you are an investor, feel free to just stick your fingers in your ears and scream, nah, 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 I can't hear you for the next minute. I'll wait. This isn't about Bitcoin or about the company's strategy even. It's about simple math and how it's not going to end well for investors. First, the software side of the business is basically non-existent. Revenue has fallen at a 3% annual pace over the last 3 years to $467 million, and the company is deep in the red on income. At a 2x price-to-revenue multiple, that would justify maybe a market value of $1 billion. So on the stock's $81.5 billion market cap, I think we can safely say that investors don't give a shit about the software business. This is a bet on Bitcoin, and that's fine. BTC has exploded this year, and I'm not going to sit here and say that it won't continue higher. But the problem here is MSTR currently holds 444,262 Bitcoins, which as of Friday's price of 94,543 each, would be worth $42 billion. That means investors are paying $81.5 billion to hold shares of a company whose value is exclusively in an asset worth $42 billion. Now, please feel free to explain that math if you can, because from where I'm sitting, it looks like a lose-lose for investors. If Bitcoin prices falls, then enthusiasm comes out of the shares and they fall more. Case in point, MicroStrategy's 2.8% drop Friday, while Bitcoin was down less than 1.4% at the time. Now, if Bitcoin does continue higher, MSTR is likely to rise as well, but cannot beat that return on Bitcoin over the long term. That gap between the stock's value and its actual holdings worth just isn't going to support it. Now, okay, if you're investing in MSTR as a trade, expecting Bitcoin to rise and then MSTR to rise faster before selling your shares on a quick profit, then that's your strategy, that's fine. If, however, you are, like a lot of investors, holding MSTR long-term as a proxy for Bitcoin, I'd suggest just owning Bitcoin instead. Showing you the bigger picture here with the SectorSpiders.com sector tracker. 6 of the 11 stock sectors closed higher last week, with growth stocks outperforming as would be expected in an up market. Safety sectors like utilities and staples did underperform, along with those tied to the economic growth like materials and industrials. Now, besides just that normal selling out of those safety sectors to position in growth, interest rates also had a lot to do with this, as those higher rates on bonds make so dividend-paying stocks in the safety sectors look relatively less attractive. Here, wrapping up the year, we saw big outperformances in a few sectors and what could be value opportunities in others. Here you can see I compared this year's performances in each sector against the 15-year average best and worst performances from the Novel Investor website. Overall, the S&P 500 has run 25% over the last year, well above its 14% average over the 2009 to 2023 period. This is the first time the index has increased more than 20% in 2 consecutive years since 1997. Now, the biggest outperformances were seen in utilities, up 20% versus that 9.3% average, communication services up 35% versus 9.4% average, and financials up 29% this year versus an average of just 11.3%. That strength in financials occurred later in the year on those lower interest rates and hopes for deregulation, and that's likely to carry into the next year. The biggest underperformances were seen in energy, up just 0.9% versus a 6.7% average, healthcare up 1.9% versus 13.6% average, materials down 0.7% over the last year versus 11.9% average over that period, and real estate up 1.2% this year versus an 11.8% at 15-year average. Stocks in the healthcare sector have a good shot at a rebound on deregulation as well, though uncertainty is really high around that policy right now, and it might take a couple months to kickstart that sector. Get free access to our 2025 Best Stocks Tracker and advance notice when new stocks are added with the link in the description below. Or click on the video to the right to see my complete 2025 outlook, the stocks and sectors I'm watching. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.